Good afternoon, everyone. So welcome to our regular weekly, now Thursday afternoon webinar. We have a really good program for you today. As I hope many of you are aware, we're starting to see fewer and fewer changes and updates in the arena of the CARES Act, but we will still give you an update because there are changes. Not so much though. So Steve Denny will walk us through updates from last week so that you understand what's changed since we last talked. But the really interesting component of the program today is an interview by Terry Lammers, and Terry will be interviewing Ben Eberwein. Ben is our guest today, and he's a commercial banker with Hillsborough Bank, and you'll get a more in-depth introduction to Ben a little later in the program. As always, I want to quickly go over the logistics for this webinar. We are on the Zoom platform. We're asking everyone if you have questions that you want to pose to us throughout the webinar and throughout Ben's presentation, that you type those questions into the Q&A dialog box, and you will see a Q&A box at the bottom of your screen. Some of you it may show at the top of your screen, but it says Q&A. So use that function to ask questions. We will answer those questions live. If in fact we have more questions than we can answer live throughout the webinar, we will answer those via a recap of the questions that we'll share after the webinar. Everything that we're doing today, including the video of this webinar, the deck that will be used in the presentation, and the Q&A dialogue, will be posted on our YouTube page, and the YouTube will have a link to our Google page so that you can pick up the hard copy documents. With that said, Steve, take it away.
Great. Thank you, Marquita. Appreciate it very much. So give you guys a quick sense of the agenda. As Marquita said, we got a couple of updates to cover, and then Terry will jump right in with our featured guests. So gosh, here we are, I think 18 weeks into this thing. I keep thinking that this is going to come to an end at some point, but not quite yet. We were fortunate enough to be in a meeting earlier this week with a representative of the local SBA, which was very helpful. Couple of things to provide information on, and a lot of our clients have shared with us that they're hearing from their lenders on the PPP program that they're not yet accepting forgiveness applications, and some lenders have even said that they're going to have some supplemental documents with potentially their own forgiveness application. I just want to remind everybody that the PPP loan forgiveness application forms are available. They're on the SBA website. We have actually distributed them in our prior webinars. We'll attach them to this webinar as well. But the issue is that the SBA portal is not yet open to lenders. So Ben, I'm sure will have an opinion and will share with us what their bank is doing in that regard, and we'll hear that a little later today. But we do know that there are some lenders that are asking their clients to use the SBA forms and go ahead and get those prepared. But as of right now, the SBA portal is not yet open for lenders to be able to submit loan forgiveness applications. Next big update is that the economic injury disaster loan ran out of money this week. So over $20 billion in that fund, and they actually funded little more than 10 million small businesses. So again, I think when you look at what the SBA has accomplished over the course of the last 4.5 months, it's absolutely astounding. Roughly 20 years worth of prior production that they've crammed into a 4-month period of time. So EIDL loans are not available anymore. And for those that receive funds, we had a lot of questions that were coming to us about how were those amounts basically determined. And the general rule of thumb was 6 months of gross profits was how they determined what the business lending ability was for each of the applicants. Finally, Main Street Lending Program is open. We provided some information last week and provided some information in the download. If you went to the replay and pulled up the files, all that information, we'll share that again this week. So Again, that's a lender-driven program. So if you have any interest or need to utilize additional lending programs, go straight to your lender and find out if they are an authorized provider under the Main Street Lending Program. So that's it. Short level of updates. Who knows? Maybe next week will be the first week in 18 or 19 that we haven't had any updates, but that's where we are so far. So with that, Terry, I'm going to hand it over to you.
Nope. Thanks, Steve. How many times have we said that already, right? Well, happy to have Ben Everwine here with us today. And, you know, part of the switch that we're doing with our weekly webinar, like Steve said, it's been about 18 weeks, I think we're into this. And Steve and I had to make a decision. It's like, is this winds down? Are we going to stop, or what are we going to do? Well, we have this wonderful CEO to CEO coaching program, Chief Everything Officer to Chief Executive Officer. We'll talk a little bit more about that later. But what we're refocusing on doing is bringing people on over the next series of weeks that reflect what we're teaching in the CEO to CEO coaching program. And a big part of that program is your bankability. What makes you a bankable person? And so Ben is a commercial banker with the Bank of Hillsborough. I've known Ben for a long time. I love the way he approaches banking. It's very common sense, and he knows financial statements, which off the wall comment, a lot of them don't. So you can appreciate that about him. Ben's very active in the community. He's been a past president of the JCs in Highland, Illinois, the Rotary Club in Highland, and starting October 1st, he will be the president of our Optimist Club. So very proud about that, the Highland, Illinois Optimist Club, like the 7th largest in the United States, right, Ben?
Yeah, biggest in Illinois and top 5, I thought, in the country.
Gotcha. So Ben's a proud father of a daughter that's 8 and a boy that's 7, so that keeps him busy. But welcome to the webinar, Ben.
Thanks, Terry. Thanks for having me on.
So, hey, just quickly tell us a little bit about Bank of Edwardsville and kind of give yourself the cheap plug there.
So Bank of Hillsborough, we're celebrating, I guess it'd be 150 years. I think it kicks over to 151 coming in September. We formerly were known as National Bank. We rebranded to Bank of Hillsborough back at the end of 18 just to be more recognizable. But we've been around for 150, almost 151 years now. Locally owned, 11 locations, ranging from Highland, Edwardsville, Hillsborough, Pana. Just opened our 12th location up in Staunton, and has done very well. Everything is local decisions and just a little small hometown bank.
Great. Community bank. So we'll talk about that a little bit later, because I know Ben's worked at big banks. Actually, Ben and I used to work together back in the day at Regions Bank. And so we'll get into that. But, you know, one of the main things that we do in the CEO program is get to determine a client's bankability and get them to understand it, is create a debt schedule. So how important is that debt schedule to you, Ben, as far as being able to assess a potential lender's bankability?
A debt schedule is extremely important. In some cases, it could mean the difference of a loan getting approved or a loan getting denied. If we can go through a balance sheet and financial statements and look and see what your liabilities are and back into a rough amortization estimate of what rates are based on what your balance is now in your payments. But with an actual debt schedule, it helps paint a picture of exactly where you are in retiring debt. And I had a client here recently that keeps very good, solid financials, always quick to get them into us, and it makes going to bat for him at loan committees so much easier. But he turned in a debt schedule that showed all the breakdowns of his principal and interest payments, what the original balance was, what his rate is. So we knew exactly where the liabilities were, and it made a difference on his debt service coverage, from putting it in kind of a questionable position to a very strong debt service coverage over 1.6. So it helps us have a better comfort that we understand what your liabilities are.
Yeah, so just to back up a little bit, we kind of jumped into the importance of having it, and I'm sure there's some people on the webinar right now that are going, what is it? So, you know, basically the debt schedule is, it's a list of all the loans that you have. You know, where did you get the loan from? Who's the lender? You know, what was the original date of the loan? What was the original amount of the loan? What's the current balance of the loan? When does it mature? and what's your current monthly payment and current interest rate, and we add to our schedule what the collateral is for that loan, so you know what's holding that. So what Ben was talking about is being comes in very handy, right, Ben, as far as let's see if it makes sense, if you should consolidate some loans, or can you get a better interest rate on one that you might have.
Yeah, and an easy way to describe it over to individuals in a term that they're more familiar with. Everybody is an individual borrower at some point along in their life, and they always hear about what's my credit score, what's on my credit report. So a good way to think about a debt schedule, if you look at a credit report, it's a snapshot of what your debts are, what the payment is, the original balance, and the current balance. From that, it's easy for a bank to actually back into what your actual rate is. When we're looking at balance sheets, it's not as easy to back it in. With the debt schedule, if you put on there, I started the loan, it comes due for a rate maturity. There's a 5-year balloon, meaning that you did this loan as a 7-year 7-year rate lock or 5-year rate lock, but it was on a 15-year amortization or 20-year amortization. Then we can know exactly what's coming up on the horizon. And like you said, Terry, it helps us understand where your rates are if you're overpriced on something. A lot of times if you're earlier on in your career or earlier on the startup of the business, you don't get quite as favorable rates just because the bank evaluates it on risk. So if it's startup business, less than 2 years old, or maybe you were going through some hard times with your bank, you had some economic impacts that negatively impacted your company, but you're starting to right the ship. You turn in the financials, we're able to picture all of it. The debt schedule helps us understand where the collateral is and when debt to be retired. We can evaluate that with you.
So
and hopefully help you out.
What about having one for your personal financials, for your personal loans also, to come up with a global debt service coverage? So have you ever seen where a person qualifies very nicely from the business standpoint, but the personal debt can kill them as far as a global debt service coverage?
Absolutely. Well, we obviously look at the debt service coverage when we're looking at the actual entity, and then we always want, if it's new borrower, new entity, we want to see a global debt service coverage as well. So we would ask for business returns and personal returns. We'd ask for the debt schedule on the business, and then we would also ask for a personal financial statement on you. The personal financial statement, if you haven't heard the phrase before, it's referred to a lot of time in bank jargon as a PFS. Give me a PFS and your tax returns on the personal side, and then give me 2 years financials on the business, interim financials, if you're past 4 months into the year. But that personal financial statement is to show your assets and liabilities, so we can see what's on the personal side. And then with your credit report put together with it, a lot of times we can piece it together. But if we start seeing...
Oh, did you freeze up or?
Sorry.
Well, hey, Ben, so now you see it the flip way around too, a lot of times, where if it's a startup business and it doesn't really have the cash flow yet, if you have a strong personal financial statement, your business's debt service coverage ratio might not qualify you for the loan, but by pledging your personal assets, your global debt service coverage ratio and your credit score could get you over the top. So speak on that a little bit, and then what kind of credit score are you typically looking for?
Yeah. Typically when we're looking at credit scores, we want to see 700 or above. We start getting that 660 to 620 or 720 range. We start looking at the C's of credit more. When we're looking at the actual debt service coverage, obviously on a commercial request, we're going to start with the primary debt service coverage on the actual entity. We're going to look at the liability to asset ratio. And the liability asset ratio is how much debt do you have versus assets. So it's
collateral and cash flow, right?
Yeah. So if it doesn't cash flow, then we bring you in as a guarantor. And if the global, say your debt service coverage is a standalone as a 1.1, that doesn't meet bank requirements. It's not a deal that we're wanting to do. But if we bring in your personal assets in as a guarantor, then it turns into a global cash flow. And if on your personal financials, your income, if that's a 1.6 global debt service coverage, then that's obviously a bankable deal. And we would write that with you as a guarantor on the loan because it makes sense and you have the assets to back up the request.
It's funny, I remember back in my banking days, we had a client that had a business that was kind of struggling, and he was running it, and people, you know, you kind of like, yeah, I don't know, this one's kind of tough. But his wife was a doctor, and she made lots of money, and that really helped him as far as his banking. So, so talking about debt service coverage ratios and stuff like that, explain what a debt service coverage ratio is and what it is the Bank of Hillsboro's kind of a minimum that they look for, and where would, you know, if you had to say, if you had a debt service coverage ratio of X, we think you're right where you need to be.
So obviously, debt service coverage is a very strong indicator of if we're going to do a loan or not. Our minimum threshold, when we look at a standalone debt service coverage, we want to see a 1.2 or better. If it's below that, it's probably not going to happen unless we can have some other mitigating factor, and it better be a strong one. If it's a global debt service coverage, bottom requirement is a 1.3 debt service coverage. So that means for every dollar in revenue you're bringing in, you can pay, or for, you know, if you're bringing in 1.3 debt service coverage, you get $1.30 for every dollar of liabilities you got to pay annually.
Yeah.
So we'd like to see 1.5 or better on a global debt service coverage, or a 1.4 or better on a standalone. Obviously, the higher that number is, the better we feel about it, because it shows your ability to repay the debt.
Right. So in the CEO program, we get you as the client to understand what your debt service coverage ratio is. And our whole goal is that whenever you go to somebody like Ben, you're going to already have a pretty good idea if you're going to qualify for that loan, because you're going to know what your debt service coverage ratio is going in. So what other, you know, there's about 10 ratios that we teach in the CEO program. So I'm curious of two things. One, what's a couple of other ratios that you guys really like to look at? And then two, how do you treat a line of credit towards putting that on your debt schedule, and, you know, kind of maturity on those and things like that? Because often, to put that in context, oftentimes when you're going to buy a business, if it requires a large line of credit, it may weigh on the total amount that you can borrow to pay for the business. So we call that a teeter-totter. You know, the more you have to have for working capital on a line of credit, it may push down on the price of the business.
Absolutely. And, you know, thinking through it as a process here, I mean, obviously, there's a lot of ratios we look at. You know, the main ones, know your debt service coverage. What's the liability asset ratio? What's your EBITDA? I mean, those are things we want to see right out of the gate. You know, Terry, we talked about this a little bit, and I feel like this is a good way to roll this in. We talked about this a little bit the other day about the difference of big bank to little bank, or just bank to bank appetites. Every bank has a little bit different appetite, and you know, lending limits. So, for example, our legal lending limit is roughly $7 million, and it's based on the size of the assets of the bank. You know, a bigger bank, the Bank of America, they're going to have a lending limit that is millions of dollars. So it makes a difference on the appetite with how they look at things. When you're looking at the numbers, or you're wondering where to go with, I mean, I know that, you know, your program is a great program we talked about several times. If you look at a program with it, or if we're looking at a borrower, a company, and we're wanting to either help them evaluate where they're at, or work with them on capital needs or equipment purchase, you know, whatever it is to help them grow their business, make it more successful, it's still a relationship at the end of the day. And that's primarily what we look at. We look at it as a process. So, and something that I don't feel is taught all the way through and through with different banks and different bankers. At the end of the day, it's just an individual having a conversation, talking about what the client has going on, what the bank can offer. And sometimes it doesn't meet with both banker and client, but maybe the banker can give you advice, guidance, and then help guide you to the right person that they know along the way, because the sites are different.
So let's break that down a little bit. So when we talk about a bank's appetite for different types of loans, we're not talking about cheeseburger and fries. We're talking about what the business does, right? So I know, you know, when we was working at Regions at the time, they had a moratorium on construction companies and non-owner occupied real estate. So that meant no matter how strong of a credit you are, you know, they're not going to lend to that. And quite possibly, if you're in that where you get a 5-year balloon coming up on a 20-year note, when that thing renews at the end of 5 years, they may ask you to go to another bank, and that can be a very hairy situation. So what the Bank of Hillsboro's appetite? I mean, obviously you're in a lot of rural areas and ag, but what are things that the Bank of Hillsboro likes that other banks might not like?
Absolutely. I mean, we get founded as a farm ag bank. It's what we were based on. We are a collateral lending bank when it comes down to it. We want some kind of security on the back end of every loan we do, whether it's a pledged brokerage account or the actual real estate, operating location, real estate to be acquired, collateral of some kind, whether it's cash, equipment, real estate. Just because as a smaller community bank, giving out unsecured loans, if we started getting that scenario, we couldn't absorb those losses. And a bigger bank, like Terry said, we worked at Regions, operating lines of credit on soft receivables, soft collateral wasn't a big deal, but they wouldn't touch rental properties or non-owner occupied properties is what Terry's getting at there. And all that means is if you own commercial real estate that you rent out to tenants, wasn't good, warm and fuzzy feelings there as non-owner occupied property. We like real estate, rental properties. We've got a lot of hotels that we deal with. Obviously, we're working with those directly right now, just given the economic conditions. But that is one of the other benefits of working with us. Even though we take collateral with everything we do, we'll still do operating lines of credit as long as there's something back in it. And some of the bigger banks say that'd be a little bit of a difference. They're not willing to mitigate the request based on collateral on the backside. We keep talking about the line of credit side. Line of credits are always going to vary from bank to bank. When we look at capital needs, capital requests, obviously we want to know what's the operating cost 12 months or less, year or less, is how we evaluate that line of credit, because we go annual lines of credit, we review them every year. When we calculate the debt service coverage on that, we're just taking the interest only payments on there because that's retired before the end of the year.
Right. You're not looking at, because I know some banks will, say you got $100,000 line of credit, they'll look at that on a debt schedule as like a 5-year term note. And then that payment would go towards your debt service coverage ratio, right? So you're doing a little bit different and using the interest only on the maximum amount of the line of credit, correct?
Correct.
Yeah,
and then,
so I think what's important for our listeners to know about that is that's just another little thing, that how one bank looks at credit one way versus another bank will look at credit the other way, right? So,
absolutely.
So talk about, we talked a little bit the other day about transparency between the client and the bank. And I think, that's kind of interesting, because in selling a business on the brokerage side of our company, there's a lot of non-financial things that can affect the value or sellability of the company. So talk a little bit about how transparency can be a non-financial thing as far as a banking relationship that just might make you squirm and say, I don't think we want to work with this person.
Absolutely. There's 2 recent customers that I had dealt with, both opposite sides of the spectrum. One client always has his numbers ready to go, knows what his numbers are, provides debt schedules, financial statements, interim financial statements, quick, usually within 48-hour turnaround time. He's on top of his stuff. Makes it real easy to approve loans for him, work with him to help him grow. On the other end of the spectrum, individuals that aren't quite as transparent, it makes us uneasy, makes us ask more questions. And when I start asking a client more questions about, well, tell me what these expenses here were on your Schedule C and on this Schedule E, help me understand some of these expenses you have going on, and you can't answer that question. For the one individual, it hit rental property is what he has. And we started going through some of the expenses, and it didn't match up to what I could find on public record. And the reason it caused a concern was we did an annual review on it, and it didn't cash flow. So we have a loan that cash flowed originally, and we came up for an ACR, annual credit review. So, and that's another thing from bank to bank, their ACRs, annual credit review, is what we use. And anything over 150,000 in bank exposure with us, we require you to turn in annual tax returns and a personal financial statement if you're a guarantor on a loan. So it helps us monitor our credit, what's going on with you, if there's things we can help you with, or maybe we put something on your radar that you're not even aware of. Hey, your AR turn time is slowed down by 5 days this past year, anything been different over the last year or any changes with the business? And it might create more discussion as operating lines of credit or anything of that nature. But if you can't answer questions on your financials to your banker, whether it's me or any other banker, it makes us uneasy and not comfortable, like it be turned down.
Yeah. So that's great. The first thing that we do in the CEO program is make sure our clients have readable and relevant financial statements. So we get anything from people coming to us that they don't even really have a financial statement, or somebody that's got an income statement that's 8 pages long, and you can't analyze an income statement that's 8 pages long. So yeah, it's very important. One of our clients from Washington State in this COVID-19 situation, she was the very first PPP loan that her bank processed, and it was strictly because her financial statements were completely up to date, and she knew her banker personally. So let's talk about that a little bit. How that's probably the biggest thing that's coming out of this COVID-19 thing that we've preached all the time, but it's like one of those things nobody listens to, right? But now, you know, how important was it going through, you know, the PPP program and the EIDL to know your banker personally and have, you know, we talked about having readable and relevant financial statements, but having current and up-to-date financial statements, right?
Absolutely. Well, the PPP was such a mad dash on the bank side. And I mean, I know that you've done some coaching with individuals on that stuff, Terry, but, you know, from a banker standpoint, we were here at the bank, and in the news and the media, everybody was giving out information that, well, the bank knows what they need to do. They have the information they need to have. Never mind the fact that the actual final application wasn't released until, I think it was 10:30 the night before applications were supposed to go live. And they were still telling us, well, we don't know where to tell you to send it. So obviously it started on a very rocky go. And then it was first come, first serve. So obviously it's a mad dash to get PPP applications submitted in. Clients that have a relationship with me would call me on my cell phone. We would work directly with them. And most of them had accurate, up-to-date information because we had to have the 19 payroll per employee. We had to have your 941s for 2019. And those that were ready with it had it in line. We got their applications through incredibly quick. Now, clients that weren't on top of their financials, I have one that comes to mind directly that didn't have his financials in order. It took hours to get his stuff situated. I had to go through line by line with him to actually break down, okay, well, what are the retirement benefits that we can count in here? And exhausting. So on that situation, it got tabled until he could bring everything together. And I told him I wouldn't look at it until he had everything. Once he did, I was full willing to sit down with him. I met him on a Saturday. We went through it, but I pushed him off about 4 days because he didn't have everything ready, and I didn't have time to.
And you had 20 people standing behind him, right?
Yeah, yeah. It just.
We worked with a gentleman. I did, and he didn't have his 2019 taxes done. It's like, well, you know, it's June. So, but I said, well, just give me your 2018 taxes, and we'll work with those. Well, they're not done yet either. I'm like, well, there's not a whole lot I can do for you, you know. So it's very, very important. So, you know, you mentioned something, accounts receivable days. So, you know, that's a big thing. That's a big thing that we like to talk about: accounts receivable days, payable days, and inventory days. And, you know, the other, you know, one of the main things that comes out of the program is to know your company's cash flow. So you mentioned you talked to them about, you know, if your accounts receivable days, so if you're selling $10,000 a day worth of stuff and your accounts receivable days go up by 2, and all of a sudden your accounts payable days go down by 2, you know, you've had a 4-day shift there. That's $40,000 in cash flow. It doesn't have anything to do with net income. You know, it's just cash that's tied up in working capital. So is it often that you see as a company is growing that the working capital needs, you know, line of credit or something like that can really stress the cash flow of the company?
It can, and I don't want to say fortunate enough, but in a position where we do annual lines of credit year to year for operating lines of credit, we get to keep a better handle on that working with clients. We tend not to get into the weeds individuals, we try to refer them to individuals like yourself that can come in and help coach them on how to run the business. But it's monitor. If we notice it, we bring it up, what's changed, and just, hey, let's think about some things, and maybe I refer him to someone like yourself that can do more coaching on it. We always try to tend to shy away from advising you how to run your business, because we don't want to be a CPA to somebody. We don't be an attorney to somebody. We'll coach and guide you to the right people. But, and Terry, we've talked about this before. That's why it's so important to have a good banker, a good CPA, and a good attorney. And they all need to be in cahoots, so to speak, or at least all know who each other is.
Yeah. So what do you do? I kind of laugh at this one because you see it all the time, and I'm sure you do too. And I had a $4 million line of credit at one time. So, hey, if you need a $250,000 truck, you really don't have to go get a loan. Just pay for it on your line of credit. What do you do when that line of credit comes due and, it didn't get rested, right? It didn't get pulled down to zero. What do you do with that person?
So, first of all, I would not appreciate that happening on an operating line of credit for a vehicle unless it was an equipment vehicle and we were going to term it out right away. So if someone uses an operating line of credit to buy a fixed asset, so let's say a work truck. So you use your line of credit to go buy the work truck. You give me a call about it, no worries, get the advance done. As soon as you got the truck, bring the title in here, we'll actually just term this out on that piece of equipment. So that way it's amortized and it's getting retired accordingly. We did not like to see that sit on a line of credit. And if it happens, then what we would do is we'd make you split that out to the asset and term it out. Or if that specific asset you bought, for whatever reason, if it's a blanket UCC somewhere else that we don't have, or if for whatever reason, if we couldn't take that as collateral, your line of credit, let's say you had a $100,000 line of credit with us and you bought a $50,000 work truck, we would drop your line of credit to $50,000 on a borrowing base, and then the other $50,000 we would amortize out, and then come renewal time for the line of credit, we'd reevaluate, see where you were with both balances, and adjust accordingly.
But you've never seen that happen.
Oh, I can't say that. I can't say that with a straight face.
Talk about, you gave an example the other day when we spoke about a family that used the line of credit to help one of their kids out. Remember that story?
Yeah.
That was a neat story. Yep.
So, I always talk about the relationship. It really is truly a relationship with your banker. And if it's not a relationship with your banker, you're probably not with the right banker possibly. But your banker you should work with them just like you would your next door neighbor. And hopefully that's a good relationship. But clients came to me, farm clients of mine, good people, they're on the tail end of their career, and their daughter had a couple things happen, some hard times fell on her. They wanted to put some ground up for a line of credit. Okay, we talked about the big picture. So for a situation like that, they could qualify for like a $150,000 line of credit based on their cash flow, because we couldn't use the daughters and use the pledged asset from mom and dad. What we did was we looked at that line of credit they wanted to help the daughter with to consolidate her debts for her. And the goal is that daughter will take over that debt. We'll move it over to her name as soon as income's in line that she can do it. Mom and dad will keep the asset pledged. But when we work the cash flow through, that was going to be amortized over 5 years because it's short-term debt that needs to be retired out. So we only gave a $50,000 line of credit to mom and dad to help their daughter. And if it was them on an operating line of credit for the farm, we could have gone $150,000 on the line of credit for the farm, knowing that they would revolve it, no problem. But when they were going to help the daughter, we pieced that together so that the solution was, you want to help the daughter get out of debt. We took the asset, we limited it to $50,000, that if daughter couldn't take over the debt, mom and dad could still service that without affecting their farm operating line of credit. So,
yeah. So I got several more questions here. We can keep going on, but if anybody's got a question, feel free to type it in the Q&A chat button, or not the chat button, the Q&A button at the bottom of the screen, and we'd be happy to, take a stab at your question. So we'll do that. We'll just kind of roll with it. So then another thing interesting to talk about. I don't even know the answer to this, to be honest with you. Do you guys do SBA loans?
So we'll do 504 SBAs, but we won't do 7A SBAs because of the soft collateral.
Talk about the difference, you know, because some banks won't do SBA loans at all. Some banks just do 100% SBA loans. And so when do you look at taking, and what do you think, you know, I guess what's the bank's, you know, appetite for that? Would they rather keep the loan conventionally and you only use the SBA when you can, or how do you use the SBA as a tool, the 7A loan and the 504 to get a client across the finish line?
So the 504s are the only ones we do here. So I'll keep to that part of the topic. That way I don't get dangerous in a 7A conversation. But on a 504,
which is used for
504 is real estate secured.
Okay.
And there's basically two different ways to do it. There's 504 purchase loans where you're purchasing real estate and using an SBA loan to do it. And then there's also, I can't think of the name of it, but it's a 504 consolidation loan that can be used to wrap some debts together to re-amortize them. So we prefer to keep, if it's a bankable deal, we prefer to keep it in-house. It's cheaper that way. It's better for the client most times. The SBA, there has to be a reason we want to go that way. So I've got a client that we're working with now that they make money. They are profitable. They make money, good credit, good character, collateral's good. The industry they're in, it's a retail industry, and you know, for the reason that we're just not sure what the retail side would look like, and you know, the space that they're in, we prefer to take that as a 504. The benefits to the client are we're going to be able to take this out on a longer amortization, which will drastically increase his cash flow, so he can retire other short-term debts off, or build up more operating capital for growth with other locations. That's up to them to decide how they want to use those funds. They also get a lower rate for the SBA side of the loan. Now, I had a separate client, but on the 504, just to clarify that, the whole loan on the 504 is not an SBA loan. What the SBA is, it's an SBA guarantee to the bank to help improve our collateral position, to make us more comfortable with the risk the bank is taking lending the money out. So on a 504 for this specific scenario, the loan is going to be for the full amount to put two different debts together. We're only going to be on the hook for half of that, and the SBA is going to be guaranteeing us the other half. So for us, we're basically 50% loan to value on this deal we're going to give the client. The client's going to get a longer term amortization to free up cash flow that they can use this money elsewhere in short-term debts. And then they're going to have a better rate on the SBA loan. The bank side loan, it'll still be a 5-year lock, and it'll still be a 20 or 25-year amortization. Once we button it up, whatever the SBA is, we have to match that amortization on our bank loan. And then the rate, we typically set it as a 5-year lock, but as a 5/5 ARM. So it has the same maturity date as the SBA loan. So they'll have two loans, one of the SBA, that I think SBA rates right now on 504 are something like 2.6. So they'll have that on the SBA side. And then ours will be a 5/5 ARM that will set a spread up front. And then every 5 years, our side will automatically update to whatever that spread is to the 5-year treasury. So, but there's always a reason we want to go that way, either to help us get more comfortable with the risk, and it's got to be the right thing for the client. I have, you know, when you ask about SBA, we had an individual, it's a prospect, has nothing with the bank right now. They just saw that we had a new location there in Staunton, asked some questions about SBA, and I've been talking with them. For the amount they were looking to borrow, their personal financial statement is extremely strong. So they don't need to go SBA because they have the global debt service coverage to swing this on their own as far as on bank paper. So we actually got them steered away from an SBA loan to go in-house with the bank and just personally guarantee the loan request. And it's going to save them, gosh, I want to say $2,000 up front just on the origination fees. Yeah, just on the origination fees. And it's going to give us more flexibility because there's not going to be any SBA paperwork that has to be dealt with. So there's less documentation that we need, less hoops to jump through. From the SBA side, you do have to give them everything shy of your firstborn. It's got to be the 3 years tax returns, 2 years projections, personal financial statement. It's a lot you have to turn in. So
Okay, great. Here's another sticky subject all the time. What about personal guarantees? When, do you require them on everything? When will you release a personal guarantee? I mean, if I have a $500,000 loan and I get to $100,000, will you release it then? Or, and I know every bank's appetite is different on that. So talk about that a little bit.
So I personally prefer to have a personal guarantee on every loan, because if you're asking me for money for your business, if you don't believe in your business enough to personally guarantee the loan, why should I give you money for the loan? Now, you are right. It is a sticky topic. Clients push back all the time because they don't want a personal guarantee in there. And I won't get into the legal stuff. That's things you can go through with your attorney. But in the grand scheme of things, when I look at it, if I'm working with a client, if you're not willing to give me a personal guarantee if I need it or if I want it, then that comes back to a transparency and a character issue for me. But it's not an end all. If a project will go all the way on its own and a client's triple A rating, meaning these are solid gold, any bank would kill to have them, we can get by without a personal guarantee, but that is a once in a blue moon type situation. Probably better odds of winning the lottery than me writing a loan for you without asking for a personal. So
that's great.
I don't know if the answer people want to hear, but as you believe in your company, then a personal guarantee should be a moot point.
Yeah. So one more question and we'll kind of start wrapping it up. In my book, in the chapter on banking, I talk about, one, people think of a bank as a bank, and it's not. We talked about here, a bank's appetite for different types of loans. But Ben, I know you've worked at a big bank and you worked at, a community bank. What are some of the pros and cons? Because there's reasons to bank with a big bank, and very good reasons. So, and there's reasons to bank, I would say with a community bank. What's your thoughts on that?
Yeah, there are big differences. Not that you notice them as much on the outside, but being on the inside, both of them, they stand out very bold. Working at a big bank, it was very cookie cutter. Here's the box. It's got to check all of them, or we don't want it. Here's the industries that we'll touch. If it's not one of these industries, we won't take it. So they predetermine everything. And when you're working with a loan officer at a big bank, and I pick any big bank, U.S. Bank, Bank of America, Chase, doesn't matter. If you're working with a big bank, most of the time they're submitting that through. It's going to an underwriter somewhere. When I was at Regions, it was going to underwriters down in Nashville, Tennessee, that I never got to meet, never got to talk to. It just went to them. They did their work with it, spread the numbers. They say, well, I came up with this, not what you came up with, and doesn't meet their criterion. So unless you can give me something better than this, it's denied. But at the same time, if they look at an appetite of unsecured or soft collateral, a lot of big banks are going to be more comfortable with that as long as it's an operating entity. Whereas on our side, we don't want soft collateral. We don't like soft collateral. We'll take it. Soft collateral being accounts receivable, inventory. We'll take them. We'll use them. But we won't do anything unsecured. Everything's got to be collateralized. So that's a main difference between a big bank and a community bank. We're always going to want collateral to limit our risk and make sure that we don't get caught, with a big loss we have to write off. Another difference to companies, if it's a bigger company, a lot of times a bigger bank might help them more because of the technology aspect. Big banks, they can invest a lot of money into their IT departments, their wires, the treasury management services, payroll. There's a lot more that they can streamline and improve for helping a company with their, not to say cash flow, but their just their management of the books, payroll, wires out, ACH. They have better technology.
Yeah, so it is interesting. I tell a story in my book about my mom and dad. They sold their house and wanted to. So I'll tell the story first. We've got a quick poll question for everybody that's on. Steve, you want to pop it up? So do you know your debt service coverage ratio? So we'll give you a couple of minutes to answer while I'll tell you a quick story. So I was working at Regions, big bank, And my mom and dad sold their house and they wanted to buy a duplex. So you remember this? I think he was there. So they came to me.
Yeah, it was me.
Needed what we would call a bridge loan. You know, they needed a loan to pay for the duplex before they sold the house, right? As soon as they sell the house, to pay off the loan. So my mom and dad come to me at the bank and they're like, hey, we need this loan. And I'm like, no, you don't want to do that here. And I told them to go to another bank in town, and I called the bank president and said, who knew my mom and dad very well, and said, hey, they're coming over. This is what they need. And in the book, I kind of jokingly say that the loan was approved before they even got there, whether they knew it or not. But they was totally flabbergasted. It's like, why would you not do that with us? And it's like, it would have taken 6 months to get this done at a big bank. We'd had to have an appraisal on the house, a home inspection, go through the title search, and just on and on. And, the small whole town bank, it's like, oh, Carl, hell, yeah, we know you. Here's a piece of paper to sign, and here's your check. So it can be comical. I did talk to another smaller community bank just this week. And I said, well, hey, they had a customer they wanted to talk about. Let's do a quick Zoom. And it's like, crickets. It's like, Terry, we don't do Zooms. I'm like, well, you don't do any video conferencing? It's like, no, Terry, we don't do that. And I'm like, you gotta be kidding me. So, I mean, you find all flavors. So, Steve, did we get any answers on it? You're muted. So if you want to.
Talking to him, I got to tell you, I appreciate that you brought up a story about your mom and dad, because that was me on the big bank side.
Yeah, Ben was wanting credit for the loan, and I run him off, and he's like, what are you doing? So what do we got, Steve?
All right, let me end the poll here, and we'll see what the results are.
Yeah.
There you go.
Wow. I'm really surprised. I kind of expected that to go the other way around.
Yeah. Two-thirds yes, 1/3 no.
Good job, guys. That's awesome. So cool. Well, hey, Ben, it's been great having you on. I think we covered. Did I miss anything, or we got like 1 or 2 more slides? We do have, if you're ever interested in talking to us about the CEO program, it's set up as a 20-session course. The first 12 months are back-to-back. And the next 8 sessions are quarterly, just to kind of keep you on track. So we're not like a chiropractor, there is an end. And we also have an online course. So the website to the online course is Business Profit Improvement Plan. It's completely online. We typically sell it for $650. We just introduced this course last week. So right now we've got a early promo code of $150. So if you go to the website and you're interested, put in that promo code of save 150 and you'll get the whole thing for $500. It's really neat. The online program is only 4 sessions that we take you through, but you get all the Excel templates that we use in the CEO to CEO program. It's a narrative that takes you along on how to do it. And then you do your hands-on work, and then there's a test after each session. Once you've passed the test, then you go to session 2. So very informative. It also goes over the profit improvement plan that we put in there, or what we call the optimal income statement. So you'll learn that. You'll learn all the ratios that we talked about. And maybe it'll give you an appetite if you wanted to go through the CEO to CEO program. We offer that in 2 different ways. One-to-one coaching, or it's really not one. I'm going to reframe that a little bit and say not one-to-one, but one CEO coach to your company. So a lot of times people will come to us with, maybe it's the owner of the company and the CFO, or the husband and the wife, or husband and wife and a sibling that's going to take it over in the future. But it's really a transformative thing, and it's just really neat, the comments from references we're getting out of the course and stuff like that. So yeah, so you can find us at www.innovativeba.com. There's a website for my book, You Don't Know What You Don't Know. You go there, you can there's 75 questions in the book, and that was the last thing I did in writing the book, was write those questions at the end of each chapter. And I got to tell you, for me, writing a book was painful. So, it was when I was writing those questions that it kind of had the aha of, you know what, if you know the answer to these questions, you'll have learned something. So pretty cool. Was very fortunate and honored that Forbes magazine rated the book as a top 10 book to read in 2019. So you can get that there. But hey, we're always here for you. Ben, it was great having you on. Any last thoughts or comments before we let you go?
The only other thing I wrote down on my notes, just because a bank will approve a loan for you doesn't mean it's the right loan to do. And you can get in that more with clients when you meet on them, but just because a bank says, yes, I'll approve this loan for you, doesn't mean it's the right loan for you. You got to look at it. If it's equipment and they say, oh yeah, we'll write that equipment loan for you. We'll just take this ground, that ground debt, this equipment debt, we'll put it all together and put it out on 25 years. Well, that equipment's not lasting 25 years. So always be mindful.
We got to take 1 or 2 minutes to talk about that, because that is an excellent subject. So I have a client right now that I would say he was sold a loan. So I think it's very important for everybody listening to know that at the end of the day, what are you, sales? I mean, Ben, you're a good banker and you give good advice, but a lot of bankers are just a salesman. They're selling money and they get paid commissions for money that goes out the door. I have a client right now. So Ben, I didn't make a comment at the time, but the debt service coverage ratios that you guys are talking about, 1.2, 1.4, those are very aggressive. In a coaching situation, I would tell you that I wouldn't want to go below 1.7, and I coach my clients that 2 is where they should be, and you'd be whistling Dixie with that all day long, right? So those are pretty aggressive, but they bought a business. And on an SBA 7A loan, you can get a 10-year amortization. My argument, and all the companies that I bought, you got to be able to pay for that company in 3 to 5 years, right? So if you amortize that loan over 5 years, they would have had a debt service coverage ratio of like 0.8. It just won't cash flow. But if you amortize that loan over 10 years, you're going to come up with that 1.4. And a lot of banks will say, hey, we'll run with that. But what happens in that 10 years? You need new equipment, and they're just strapped and they're stuck with that loan. So Ben, thanks for bringing that up. I mean, that's an excellent, an excellent thing to say.
Good. Yeah. Yep. And that's something a business owner, every business owner needs to evaluate every time they look at a loan. When a bank's talking about the amortization, they need to think about the lifespan of when that needs to be retired. That debt needs to be retired. But I keep saying debt be retired, when the debt needs to be paid off by. But because a loan can happen doesn't mean it's the right way to do the loan.
The loan needs to match the purpose, and there is a danger in that. Now, that also being said, I will many times tell a client, hey, take that 10-year amortization rate, because there's no early payment penalty, right? So that's where it kind of gets into the importance of knowing your ratios. Make that 10-year debt payment, save some cash until you're comfortable, your current ratio is up above a 2 maybe, or something like that. Then start chomping down on that debt and pay it off, right?
That's right.
So yeah. Cool. All right. Well, I hope we didn't ruffle any feathers with that. I'm not degrading any salesman or anything like that, but it is a very valid point, though, because believe me, we see it. And unfortunately, we see it a lot. People will get sold a loan, and it's funny, and I appreciate you bringing that up, Ben. So cool.
Yeah. Great comments, Terry. And I'm going to jump in here too, because I really appreciate, Ben, your presentation, and Terry, the two of you, your give and take in the conversation around this, because I feel that you have done such a phenomenal job of kind of pulling the curtain back and kind of seeing what goes on behind the curtain, so to speak, in banking. And as Terry and Steve know, Ben, you and I haven't talked about this. I come from a long banking career, and I've been with large banks and small banks, and everything that you say is so true. And to Larry, on your comment, I see your smile point, your LOL sort of on the back end of your comment, but it is true, and it is so important that as a business owner, you know your banker. your banker's required to know your customer, and they want to see everything. So, they have asked you for every piece of documentation they can about you, and they want to know everything about you. But it's so important as a business owner to know your banker. Know your bankers, if in fact you have a bank to serve one purpose and a bank to serve another purpose. And I think that the conversation, Ben, that you and Terry have had is so perfect at that. I'll share my story. I was with a bank at one time where we literally had sales goals. The customer facing team had sales goals. And you may come in and say, Marquita, I'm looking for a product from you that can help me fund or finance a specific acquisition or growing my business. You bet I had goals to sell you and to have you move all your deposits from wherever they were back over to my bank. So it became a very contentious situation, if you will, around I will do the loan if, kind of situation. And as a business owner, you really need to have your antenna up around situations like that and know when you choose your bank, who that person is, who you're doing business with, and what is likely to get done for you personally. It's not just deposit accounts. It's not just a simple real estate loan. It's not just a simple business loan, because when you're ready to grow that business and you need money quickly, you don't want it to be difficult. And I see you laughing, Terry, so I'm going to turn it over to you and let you make some comments.
Yeah, wow. Ben, we was finishing up and you opened a whole can of worms.
Yeah.
But no,
I'm sorry.
Wow. Marquita, you were spot on. And it's like, gee, Ben, never had been in that situation, have you? So, but another thing, so we talked about, it's very important to know your banker, know what their appetite for loans and what type of loans. But the other thing that kind of brought to my mind, Marquita, is have an annual conversation with your bank. So, and Ben may not like this, but I had two banks. And actually, I had a third bank in the wings, because what's scary is the bank will change its appetite. All of a sudden, hey, they're happy to deal with it. It's like, oh, well, overnight we decided we don't want no more construction loans. Oh, crap, now I got to find another bank. Well, either split your banking relationship, and if that doesn't make sense, at least talk to another bank so you have somebody else that's familiar with what you're doing, right? Ben, you'd agree with that, wouldn't you?
I would never
be the main bank. Hey, why not be the one in the wings that if the other bank hiccups, because banks will hiccup. And I talk about a story in my book where all at once they got a new credit officer, and I thought I was just going to meet the guy. And next thing I know, I'm sitting down in the boardroom and he's pounding his desk on the, bam, 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 your gross margin's going down, and sooner or later he's going to be negative. It's like, I'm sitting there like a deer in the headlights going, this guy has no freaking idea how the cash flows through my company. And I knew it better than him. And it took me a year to get all new appraisals and stuff like that. But my lending relationship with that bank ended the day he was pounding his finger on a desk in front of me. And that's a true story. So, all right, it's 3:59. Ben, if Steve, you got anything to say? Marquita, I'll let you take it over. And
we're just going to make one quick go around. And Ben, I want to give you an opportunity for one last set of comments. And Steve, you're going to get the very last word.
Well, I want to ask Ben a question first before we do.
Okay, go ahead. Go with it.
Ben, with all this aid that the federal government has flooded the markets with, do you have an opinion on how that's going to affect business owners, as we look forward 6 months from now and when they're looking at their year-end statements?
We look at this a lot. We look at our book, what's all in our assets, and we still want to see how we clear Q3 and Q4 with clients, how the businesses survive past the stimuluses that just came out. And for that reason, we were very hands-on, active with clients. We want to know that they understand where they're at, that they know what could happen, and that they have a plan in place to weather the last 3 to 6 months of the storm, not knowing how COVID could impact the rest of the year. So it'll be interesting.
Well, God bless you. You guys are doing good work. It's an honor to have you today, and it was an outstanding presentation you provided for our audience. We're very grateful. Thank you.
So just one more thing real quick here. Next Thursday, our guest will be Amanda Ashinger with Solstice Production Video in St. Louis. And we're going to have a conversation around, and she's going to have some examples of how to use videos to build your brand within the company. So that in the CEO portion, we kind of fall under a non-financial thing that might affect the value of the company. You know, if your company has a very strong brand, even if it's not performing 100% financially, it may be somebody that wants to grab that brand because they know they can build it with something they already have. So that's my last 2 cents worth.
Okay, great. Steve, do you want to make a last comment?
I'm there. Ben,
You're done.
again,
Okay,
thank you very
Ben,
much.
any last comments?
Appreciate you having me on. The only thing I would leave you with is your banker might tell you no, but it's not a no as in I don't want to do business with you forever. It might just be no, not on this request, or this is our thoughts on the request. Maybe hold off on it. We don't have an appetite. So a no is not a never do business again. It's for this point in time. So just keep that in mind when you're working with your banker. And other than that, thanks for having me on.
Great, Ben. Thank you so much. Awesome presentation. And for everyone on, keep an eye out for an email. You should receive it within the next 24 to 48 hours. That will have a link to our YouTube site. You will be able to go back and review this this presentation, but the YouTube site will also have a link to all of the documents that you saw during this presentation, including the presentation and any documents from the Treasury or SBA that Steve mentioned earlier. So good night. Have a good, well, it's not quite good night. It's about 4 o'clock. So have a great evening, and we'll see you next Thursday.
Thanks, everybody.
Bye-bye, everyone.
Take care.
Here.